What if I told you the biggest reason your trades fail isn't your strategy, but your perspective? You're watching a 5-minute chart trying to make decisions, a 60-minute chart already answered. That's why Brian Shannon begins technical analysis using multiple timeframes with one of the most critical insights in all of trading. No single chart gives you the whole truth. Price behaves differently depending on which window you're looking through, and unless you synchronize your view with the larger context, you're flying blind. Most traders think they're trading setups, but in reality, they're trading chaos. You see a bullish pattern forming, maybe a clean breakout, but on a higher time frame, you're just looking at a retracement in a downtrend. Shannon exposes this trap immediately. Trading without a multi-timeframe approach is like walking into traffic with tunnel vision. You must zoom out to understand the battlefield before choosing your shot. Shannon introduces the foundational principle of his framework. Higher timeframes define the environment. Lower timeframes define the execution. He's clear about the sequence. Top down, always. You begin by identifying the trend on the weekly chart, refine it on the daily, and look for entries on the intraday. It's not optional, it's essential. Because every trade you take must be in sync with the larger flow of capital, or you're simply gambling. Consider this example. You see a stock moving up on the 15-minute chart, and you jump in long. But had you looked at the daily chart, you'd have seen it was hitting long-term resistance. The result? A clean setup that fails, and you start doubting your method. Shannon's warning is brutal and clear. Context is king. Without it, you're just noise. This is where the psychology deepens. You don't just need more charts, you need more discipline. Have you ever ignored the higher time frame because it didn't match your bias? That's your ego talking. You want the trade to work so badly you're willing to blind yourself to conflicting evidence. Shannon's cure is structure. A checklist, an order of analysis, weekly first, daily second, intraday last. It sounds simple, but Shannon shows that most traders reverse it. They make snap decisions off a 1-minute chart, then later try to justify it with the daily. That's emotional trading in disguise, reactive, impulsive, and undisciplined. The right process forces you to slow down and align your setups with the bigger picture. And the moment you do, you stop chasing every flicker of movement and start trading with intention. What's powerful about Shannon's approach is how it resets your expectations. You stop looking for the perfect chart and start looking for alignment. When the weekly shows an uptrend, the daily shows a higher low, and the intraday breaks resistance. That's the kind of clarity that produces high-quality trades. Not certainty, not perfection, but probability tilted in your favor by time-tested structure. Other masters like Mark Douglas echo this concept. The market doesn't owe you anything, Douglas says. The market only reflects the collective actions of all participants across timeframes. Shannon helps you see that structure unfold. And when you start seeing the harmony between them, your confidence builds. Not because you control the outcome, but because you understand the game. That's the wake-up call. You've been too zoomed in. Shannon's entire book is built on this premise. You must train your eye to move across timeframes like a pilot scanning instruments. Ignore one, and you crash. Integrate all, and you navigate with edge. So here's your first assignment. Pick a stock, and before you trade it, check the weekly trend, the daily support resistance, and only then, look at the 15-minute for a trigger. You're not trying to guess what happens next. You're trying to participate in a larger flow already in motion. Because the market doesn't care about your chart, but it does reveal itself to those who know where to look. Now that you understand why one time frame isn't enough, it's time to shift how you think about charts entirely. You're not just reading candles, you're reading structure. And that means adopting the top-down analysis mindset that Brian Shannon drills into every serious trader. This isn't just about starting from the weekly and working your way down. It's about developing a mental model that understands what each time frame represents and how they interact with one another in the flow of market context. At the top of the structure is the weekly chart. This is your compass. It tells you where the big money is leaning. Institutions, funds, swing traders with longer horizons, they make decisions based on these broader movements. Shannon explains that you're not trying to catch every twist and turn. You're identifying direction. Is the trend up, down, or sideways? That's your first filter. You ignore trades that go against it, not because they can't work, but because they don't deserve your attention. The daily chart becomes your lens. It sharpens the picture. On the weekly, you may see a trend up, but the daily will show you the health of that trend. Is it accelerating, pulling back, forming a base? This is where structure comes into play. Shannon pushes you to identify higher lows, failed breakdowns, and prior support turning into resistance. You're layering story onto trend. Then, and only then, do you drop into the intraday. Shannon favors the 15-minute or 30-minute chart for precision timing, but always within the story you've built from above. It's not about reacting to price. It's about confirming alignment. You've already established the why on the higher timeframes. Now, you're just waiting for the when. Here's the trap most traders fall into. They fall in love with the lower timeframe. It's fast, exciting, and filled with setups. But Shannon is brutally honest. Those setups are illusions unless they're supported by the bigger picture. What looks like a breakout on the 5-minute could be a bull trap inside a bear market rally. If you don't know the higher timeframe trend, you're reacting to shadows. That's where your mindset must evolve. You stop being a chaser. You become a hunter. The top-down method doesn't limit your trades. It filters out the garbage. Shannon describes it like fishing in clean waters. Why waste time in muddy currents when you could target where institutions are already moving the market? Let's walk through a real-world application. You identify a weekly uptrend with rising volume. The daily shows a higher low near the 20-day moving average. Then the 15-minute forms a tight consolidation just below recent highs. That's not three separate signals. That's a unified story. Each time frame builds on the one above, giving your trade both context and conviction. And it's not just theory. Shannon's charts are filled with annotations showing how these timeframes interact. A daily breakout means nothing if the weekly is still locked in a range. An intraday setup has no power if the daily chart shows clear overhead supply. You begin to see how amateurs trade isolated ideas while professionals trade complete narratives. This mindset shift affects your psychology too. You're no longer attached to every candle. You're observing alignment, and when the time frames don't agree, you sit out. Shannon calls this neutral alignment, when the weekly, daily, and intraday are all saying different things. That's not uncertainty, it's clarity. You don't have an edge, so you don't act. Compare that with the teachings of Jared Tendler, who stresses the importance of emotional control through structure. This is exactly that. Top-down analysis gives you a mental model to lean on. When you understand the role each chart plays, you stop acting on impulse and start acting from process. So the next time you're tempted by a sharp intraday move, pause, zoom out. Ask, what story is this price action a part of? If it doesn't align with the higher timeframe narrative, you let it go. Because you're no longer hunting trades, you're aligning with structure. And that's how professionals think. If timeframes are the map, then trend direction is the compass, and anchor points are how you know where you are on the journey. In this part, Brian Shannon takes you deeper into the structure of market movement by introducing the concept of anchoring. It's not just about identifying trends. It's about understanding where they start, where they pause, and where they may reverse. Without anchor points, you're not reading the market. You're guessing. Anchoring refers to specific price levels where movement becomes significant. These levels aren't random. They mark shifts in sentiment, breakouts, breakdowns, prior highs, and lows. Shannon emphasizes the use of the volume-weighted average price, VWAP, from these points to measure whether buyers or sellers are in control. You're not just asking, what is the price doing? You're asking, since that important moment, who's winning? The psychology behind this is powerful. Have you ever entered a trade and felt confident until price dipped slightly below your entry? That's because you were attached to the trade, not to the structure. Shannon teaches you to detach by looking at anchored levels that objectively measure control. VWAP from earnings, from gaps, from breakouts. These aren't guesses. They are reference points based on actual market behavior. This changes how you view support and resistance. It's no longer about horizontal lines you drew with a ruler. It's about dynamically understanding how traders are positioned over time. An anchored VWAP above price? Sellers are in control. Price breaking above that VWAP? A shift is happening, and that's where opportunity lies. Shannon takes it further by discussing how these anchor points allow you to reframe trends. A pullback doesn't scare you when you know the higher timeframe VWAP is still supportive. A breakout doesn't excite you if it's extended far from the anchored average, because that tells you the move may already be exhausted. Structure guides patience. Let's say a stock breaks out on heavy volume and then pulls back. Instead of panicking or chasing, you drop a VWAP from the breakout candle. Price hovers around it. That's your confirmation zone. You're watching the true battleground between buyers and sellers, and you're waiting for evidence of resolution. Not hope, not emotion, structure. This tool becomes especially useful when timeframes conflict. Maybe the daily is trending up, but the intraday looks weak. Shannon shows how anchored VWAP gives you a neutral referee. Instead of arguing with your charts, you let structure speak. That's how you remove doubt and trade with clarity. Think of this as Shannon's answer to one of the trader's deepest psychological wounds: second guessing. Every trader knows the feeling: getting stopped out, only to watch the trade reverse and hit target. That frustration often comes from relying on static levels and gut feel. Anchoring to significant events, earnings, trend starts, news breaks, grounds your analysis in reality, not emotion. It also aligns beautifully with the work of Mike Bellafiore, who emphasizes reviewing your trades in context. Bellafiore teaches that every trade has a story, and Shannon gives you the narrative tools to read it: who was in control, where that control shifted, and whether that shift still holds. Anchored VWAP becomes the storyline that connects your entries to the broader plot. And this isn't just about being reactive, it's about being proactive. Once you understand the key moments that define a trend, you can anticipate where the next battle will occur. And instead of charging in blind, you wait. You set alerts. You plan. That's how you trade like a professional. Not on excitement, but on evidence. So here's your challenge now. Pick 5 stocks. On each, drop an anchored VWAP from a major event: earnings, breakout, breakdown. Watch how price behaves around those levels. Observe how control shifts. You're not predicting, you're preparing. Because once you anchor to what matters, you no longer chase moves, you wait for them to come to you. By now, you understand that trading isn't about finding the perfect setup, it's about reading behavior. That's where Brian Shannon's focus shifts to the very core of technical analysis: price action. But here's the truth: candlesticks aren't just visual markers, they're emotion. They represent the collective psychology of every trader watching that chart. And when you overlay multiple timeframes, you begin to see that psychology in motion. One of the biggest mistakes traders make is treating price as static. A bar forms, you react. But Shannon shows you how each candle is a reaction to prior structure and a clue to what's coming next. On a 5-minute chart, a strong green bar might seem like momentum, but zoom out to the hourly and you'll see it's just noise in a consolidation range. That candle is lying to you unless you know where it lives in the bigger story. The emotional depth of this realization hits hard. Think about it. How many times have you bought because you felt like price was moving? That movement triggered excitement, FOMO, and action. But Shannon trains you to slow down and ask, is this candle a continuation or a trap? The answer lies in the higher time frame. That's where you find truth. Here's the pivot. Trading is not about prediction. It's about interpretation. Price behavior reveals intent after the fact, not before. A failed breakout isn't just bad luck. It's evidence that buyers didn't follow through. A rejection at prior resistance isn't random. It's a signal of hesitation. Shannon drills this into your mindset. You're not predicting what comes next. You're reading what just happened, then acting with discipline. When you observe across timeframes, you start seeing patterns repeat, but with different significance. A hammer candle on the daily is major. On the 1-minute pop, it's background noise. That's how you start filtering for relevance. Shannon doesn't dismiss price patterns, he contextualizes them. A breakout means something only when it breaks structure on a time frame that matters. Otherwise, it's just noise dressed as a signal. And this is where trading psychology and technical analysis intersect. Price movement triggers emotion. Emotion clouds judgment. That's why Shannon teaches structure first, pattern second. You don't just chase a flag or triangle. You locate it within trend, within support, resistance, and within the story of the prior days. You no longer trade shapes, you trade stories. Consider a scenario. The daily shows a pullback to the rising 20-day moving average. The intraday prints a reversal candle. You feel tempted, but you zoom out to see the weekly, a massive overhead supply zone sits just above. That's not a long, it's a trap. That single candle was whispering lies, but the higher time frame was screaming truth. Price behavior, in Shannon's world, is not about speed, it's about conviction. Volume surges at breakout levels, failed tests of prior support, clean consolidations. All these become signals only when placed in proper context. You're building a mosaic, not reacting to splashes of color, and that requires patience. This idea echoes the wisdom of Brett Steenbarger, who teaches traders to observe emotional patterns in their own reactions. Shannon takes that outward, observe market emotion. That's what candlesticks are: collective fear, greed, hope, and doubt. And when you overlay timeframes, you reveal the full psychological fingerprint of the market's mood. So now, your job is simple. Watch price behave. Not just react, but understand. The next time you see a strong candle, ask, does this align with the broader context? Is it continuation or confrontation? Is it participating in trend or pushing against the tide? You don't need to be right. You need to be aware. Because in trading, price may lie in the moment, but context always tells the truth. You've probably fallen for it before. A clean breakout, textbook pattern, tight risk setup, and then it fails. Not just fails, but reverses hard. That's not a bad trade. That's a trap. And Brian Shannon dedicates a full portion of his teaching to helping you understand why traps exist, how they form, and most importantly, how to avoid being their victim. It starts with understanding how price behaves across timeframes in the moments leading up to these betrayals. Shannon introduces the concept of trap mechanics by showing how many breakout failures are not random. They're engineered by the market participants who understand structure better than you do. When everyone sees the same flag, wedge, or breakout level on the 5-minute, there's a high chance it's already priced in. The breakout triggers stop orders, retail jumps in, and then the institutions reverse it, because the higher time frame told a different story. This is where context becomes your shield. Shannon explains that traps rarely happen when all time frames are aligned. They happen in conflict zones, when the lower time frame is showing bullish behavior, but the higher time frame is still bearish or neutral. That's when retail gets baited in, thinking it's the start of a move, while the professionals fade it back into structure. A classic example is the failed breakout above a daily range. On the intraday chart, it looks perfect. Momentum builds, volume kicks in, and price rips through resistance. But on the weekly chart, that's just a test of overhead supply from 3 months ago. Shannon shows this with chart after chart, hammering in the message. The lower time frame may look bullish, but it lives inside a bearish world. Psychologically, these traps expose one of your biggest weaknesses: wanting to be right more than you want to be aligned. Have you ever ignored the daily downtrend because the 5-minute looked strong? That's not trading. That's rationalizing. Shannon doesn't just warn against this. He gives you the antidote: alignment-based execution. You only take breakouts when they happen within higher time frame structure. If not, it's not your trade. This applies equally to pullbacks. Many traders chase a dip thinking it's a value entry. But Shannon shows how pullbacks during downtrends are often bull traps in disguise. Without higher time frame support, they're nothing more than pause before drop patterns. Again, it's not about the pattern, it's about the context it appears in. One of the key psychological patterns here is overconfidence from short-term success. Shannon warns that winning a few fast trades on the 1-minute chart can give you false confidence. You start believing you see the future. But what you're really doing is trading noise. And when the trap comes, you won't see it until you're already caught. That's why multi-timeframe structure is not optional. It's your only defense against emotional blindness. He reinforces this through a brilliant technique: flipping your perspective. After any losing trade, Shannon challenges you to step back and look at the trade only through the weekly and daily lens. Would you have taken it if you started there? If not, it wasn't a trade. It was a reaction. This mindset aligns closely with the philosophy of Dr. Alexander Elder. You need a microscope to enter trades, but a telescope to find them. That's Shannon's message exactly. Don't zoom in to find the opportunity, zoom out to validate it. And that brings us to traps as signals. Yes, traps are dangerous, but to Shannon, they are also information. A failed breakout that reverses with volume, that's fuel for a short. A fake pullback that rolls over hard, that's a continuation in disguise. When you stop fearing traps and start recognizing their patterns, you stop being the hunted and start trading with the hunters. So here's your takeaway. Don't judge a trade by its setup. Judge it by its structure. Before you trade the breakout, ask, what's the weekly doing? Before you buy the pullback, ask, is the daily trend supportive? Because once you stop chasing moves and start aligning timeframes, traps no longer fool you. They inform you. Let's talk about one of the most misused tools in all of trading, the moving average. If you're like most traders, you've been told that a moving average is support in an uptrend or resistance in a downtrend. But Brian Shannon turns that simplistic thinking on its head. He shows you that a moving average by itself is meaningless until you view it in the context of multiple timeframes. Only then does it become a true weapon. Think about the 20-period moving average. On the daily, it may look like a clean rising line, gently curving higher. But on the hourly chart, that same moving average could be slicing through a choppy range. On the 5-minute, price could be flipping above and below it every few candles. That's not clarity. That's confusion. And Shannon's message is simple. Never trust a moving average unless you know where it lives in the larger structure. This insight exposes one of the biggest traps in retail thinking, seeing the same indicator on every chart and assuming it means the same thing. It doesn't. Shannon emphasizes that moving averages reflect trend maturity. A rising 20 MA on the weekly chart, that's long-term strength. But a spike above the 20 MA on the 1 minute? That could just be noise, or worse, a bull trap forming. Here's the key idea. Moving averages help you organize behavior. They show you who's in control, buyers or sellers, and how price is behaving relative to a dynamic trend line. But that relationship is only valid if it aligns with the bigger picture. If price bounces off the 20 MA on the 5-minute, but the daily shows declining highs and a flat 50-day, that's not a bounce, it's a misfire. So how do you use them correctly? Shannon offers a layered strategy. You begin with the weekly 20 and 50 MAs. Are they rising or falling? That gives you the long-term trend. Then you check the daily. Has price pulled back to the 20-day in a rising trend or rejected off it in a downtrend? That's your structure. Finally, the intraday charts tell you how price is behaving around those moving averages in real time. That's your execution. It's the alignment of all three that creates conviction. Not just a touch of the MA, but a touch in context. Shannon cautions against using moving averages as standalone signals. They are reference points, nothing more. You don't buy because price touches the 50-day. You consider buying because the weekly is trending up, the daily is basing above support, and the intraday is respecting the average with clean structure. This is where Shannon's method goes from mechanical to psychological. You're not reacting, you're interpreting. A bounce off the 20-day MA isn't a green light. It's a clue. You still need structure, confirmation, and alignment. Otherwise, you're just using the moving average to validate your bias, which is exactly what undisciplined traders do. And here's something few traders consider: angle and separation. Shannon stresses that a flat moving average offers no edge. A steeply rising average with wide separation from price? That's momentum, but also potential exhaustion. You must read the slope and space. That tells you if the move is healthy, extended, or due for mean reversion. The moving average becomes your emotional anchor. When you're tempted to chase a move, look at the daily 20 or 50. If price is stretched far above, pause. Wait, you've likely missed the optimal entry. Shannon trains you to think in terms of location, not excitement. And that's what separates professionals from gamblers. This overlaps beautifully with the lessons of trading psychologist Mark Douglas. Remove randomness by defining your conditions. Moving averages, when layered through timeframes, give you that structure. They reduce noise. They help you define setups, but only if you view them as tools, not signals. So here's your challenge. Take your top 5 setups and plot them across 3 timeframes using the 20 and 50 MAs. Look for structure. Look for alignment. You'll be surprised how often your best trades come when all three are pointing in the same direction, and how often your worst came from ignoring that clarity. Because in Shannon's world, it's not about what the moving average says, it's about what it means in the context of structure. Let's face it, volume is one of the most misinterpreted elements in trading. Some treat it like an afterthought, others obsess over spikes without understanding their meaning. But Brian Shannon gives volume a new dimension when he shows you how it confirms or contradicts price across time frames. You're not just watching bars anymore, you're reading participation. Who's in the trade? Are they committed? And does that commitment match the structure? At its core, volume measures conviction. Shannon teaches that rising price with rising volume is strength. Rising price on declining volume? That's suspect. But it's not enough to look at volume in isolation. You have to look at where it's occurring. A breakout on the intraday chart may seem valid, but if the daily shows below average participation, you're looking at a weak move. Shannon calls this hollow strength, and it often precedes a trap. Volume has memory. One of Shannon's key techniques is comparing current volume with historical levels at key price points. Are we breaking out with more force than the last time we tested this level? Or is volume fading, suggesting hesitation? The answer often lies not in the bar you're watching, but in the volume trend across time frames. It's that layered understanding that separates amateurs from pros. Here's the trick. Volume tells the story behind the candle. A green bar isn't bullish unless volume confirms it. Shannon pushes you to overlay volume with anchored VWAP to see where commitment lies. Are buyers holding above anchored support with increasing volume? That's fuel for continuation. Are we rallying into resistance on drying volume? That's a warning shot. This is where the multi-timeframe lens becomes essential. A high-volume move on the 15-minute chart might look impressive until you see that the daily shows low overall activity. That's not conviction. That's noise. You begin to understand that volume must align with structure and timeframe relevance. A true breakout shows volume expanding across multiple timeframes. That's when institutions are likely behind the move. Shannon also emphasizes volume clustering, multiple high-volume bars at similar price levels. This isn't just activity, it's positioning. Buyers and sellers are battling for control. If price moves away from those clusters with strength, it often confirms direction. If it stalls or returns, it shows indecision. Again, context is everything. Where is the cluster forming? Within trend? At resistance? At VWAP? All of that shapes its meaning. This thinking forces you to become a narrative trader, not just a pattern chaser. You begin to ask better questions. Not just, is this a breakout? But who's behind this move? Is this move supported by conviction? Does the volume confirm what price is suggesting? That's where real edge begins. It's no surprise that Shannon's approach aligns with the mindset of professional trading desks. Traders like Mike Bellafiore stress the importance of reading the tape, interpreting volume and price together, not in isolation. Shannon's multi-timeframe volume work is the retail version of that same edge. You stop guessing and start observing institutional behavior, hiding in plain sight. Volume can also be your early warning system. Shannon teaches that sudden volume spikes into resistance, especially when price fails to follow through, often precede sharp reversals. Why? Because that spike may be the final effort of trapped longs or the first wave of short selling. When volume contradicts price action, it's not a glitch, it's a signal. So what do you do with all of this? Start by tracking volume behavior around key levels across timeframes. Plot volume alongside VWAP and moving averages. Ask, is volume supporting this move or exposing its weakness? You're not looking for absolutes, you're looking for alignment. And that's the theme, again and again. Confirmation through multiple dimensions. Price, volume, trend, time. Shannon doesn't give you a crystal ball, he gives you a lens, a way to see the truth underneath the chart. Because once you understand volume's role across timeframes, you stop reacting to candles and start responding to conviction. So far, we've looked at the mechanics of timeframes, but now it's time to talk about application. Specifically, how you adapt Shannon's approach whether you're an intraday scalper or a swing trader holding for days. Most traders don't fail because they use the wrong time frame. They fail because they apply the right tools in the wrong time frame. And that misalignment isn't just a technical mistake, it's a psychological time bomb. Brian Shannon explains that trading style and time frame must be in harmony. You can't apply intraday logic to a swing trade, nor can you expect intraday noise to give you clarity on a weekly trend. And yet, this is exactly what most traders do. They let their execution time frame override their analysis. They start on the 5-minute chart and work backwards. That's backwards trading. If you're a swing trader, your dominant time frame is the daily chart. That's where your structure lives. Your trade entries must respect that. Your stop loss, your risk profile, your emotional expectations all must match the rhythm of that chart. Shannon warns that traders often sabotage themselves by looking for precision entry on the 1 minute, thinking it gives them control. But all it gives them is anxiety. You're trading the market's tempo, not yours. For intraday traders, the rules are tighter. You need a high degree of precision, but not at the expense of structure. Shannon shows how successful intraday traders still begin with daily levels. They still identify the weekly bias. The difference is in execution. They enter based on 5-minute or 15-minute patterns with intraday VWAP, moving averages, and volume behavior as triggers. But they do not enter blindly. They wait for setups that align across the board. Let's bring this to life. Suppose you see a stock with a strong daily breakout. You want to ride the momentum. If you're a swing trader, you wait for a daily pullback. If you're an intraday trader, you look for a clean opening range breakout on the 5-minute that respects prior day's highs and is confirmed by VWAP. Both trades exist, but they are not the same trade. They are two separate battles on different timelines. This distinction matters, especially under pressure. A swing trader who panics because a 5-minute candle goes red is not trading a plan. They're reacting to noise. Shannon teaches you to detach from the smaller waves and focus on your chosen current. Conversely, the intraday trader who ignores a key level from the daily is walking blind into overhead resistance. The danger comes from ignoring time perspective. Psychologically, this is where traders suffer the most. Shannon calls it time frame confusion. Your expectations don't match your analysis. You expect swing trade profits on scalper patience, or you demand intraday speed from a daily base. Neither works. You end up forcing trades, bailing too early, or holding too long. And the root of that behavior is misalignment. What's the cure? Process. Shannon advocates defining your identity. Are you a swing trader or intraday trader? What is your dominant time frame? What structure governs your trade thesis? Once you define that, everything else flows from it. The entry chart is just the final layer. It's not where the idea starts, it's where it gets executed. He reinforces this with examples. A daily consolidation breakout may take 3 days to unfold. If you're entering on the 15-minute and panicking after 2 red bars, you've missed the entire purpose of the setup. The market isn't wrong. You're out of sync. Shannon trains you to zoom out, reset expectations, and let structure play out on the correct time frame. This ties back to everything we've learned. You align trend, weekly, structure, daily, and execution intraday, but only according to your strategy. That's the core of his system. There's no best time frame. There's only the right time frame for your process, your psychology, and your plan. So here's your action. Pick your dominant time frame. Then backtest 5 trades using Shannon's top-down approach. Identify trend, structure, and execution in order. Track how staying true to time frame kept you grounded. Because when time frames match your strategy, you don't just trade better, you think clearer. You're at a dangerous point in your development if you haven't faced this yet. When the weekly says one thing, the daily says another, and the intraday throws gasoline on the fire. Conflicting time frames create psychological chaos. You doubt your setup, you hesitate, or worse, you force a trade trying to make sense of the noise. In this section, Brian Shannon confronts that emotional conflict head-on and gives you tools to resolve it with clarity and calm. He starts with a simple truth. Markets are not always aligned. That's not a flaw, it's reality. Sometimes the weekly is in a downtrend, but the daily is forming a higher low. The intraday might be building a bullish flag. Traders who don't understand how to read that conflict end up misinterpreting what they see. Shannon's advice? Stop trying to resolve the contradiction. Instead, learn to rank the timeframes by relevance. That means identifying the dominant timeframe for your strategy. If you're swing trading, the daily rules. If you're intraday, it's the 30-minute. The weekly offers background context but doesn't drive your entry. Shannon teaches that conflict isn't something to fear, it's something to observe. When timeframes disagree, you step back and wait, because no edge exists when the story isn't clear. Here's how that looks in practice. The weekly is in a downtrend. The daily rallies up to prior resistance. The 15-minute shows a clean breakout. Should you go long? Shannon would say, probably not. Why? Because that intraday breakout is happening inside a daily test of supply within a weekly downtrend. 3 strikes, no conviction. Conflict equals caution. But here's the nuance. Conflict can also create opportunity. Shannon describes trades that begin in conflict but resolve in alignment. That's where patience becomes your edge. You watch the lower time frame breakout, but don't act. You wait to see if the daily confirms with a higher close. If it does, you then reframe the idea. That's a shift from noise to structure, from impulse to process. Psychologically, Shannon teaches that conflict feels uncomfortable because it triggers indecision, and most traders hate that feeling, so they react. But discipline means doing less, not more, when clarity is absent. This overlaps with Mark Douglas's core idea. You don't have to trade. You only trade when you have an edge. Shannon reinforces this through structure. When charts don't align, you don't trade. You observe. And that's where many traders fall apart. They treat analysis like a test they must pass. But Shannon reframes it. You're not trying to figure out the market. You're trying to listen to it. When the time frames shout different things, they're telling you, not yet. And that's valuable. Because not acting is also a decision, and a powerful one. Another key lesson here is emotional readiness. Shannon warns that traders often force alignment where it doesn't exist. You see what you want to see. You cherry-pick the time frame that supports your bias. This is trading on hope, not structure. And the cost is real: emotional exhaustion, confusion, and inconsistency. His solution? Neutrality. Let the chart speak, and don't override it with desire. So how do you develop neutrality? By having a process. Shannon recommends journaling conflicts. Track trades where timeframes disagreed. Write what you saw, what you did, and how it played out. Over time, you begin to see patterns. You start recognizing the setups that begin in conflict but resolve in alignment, and you learn to wait for that resolution. And here's the ultimate shift. You stop needing to be in a trade. You stop chasing setups. You trust that when timeframes align, the trade will appear. Until then, you observe, you learn, and you prepare. That's the emotional maturity of a real trader. So your next step? Review your last 10 trades. Highlight the ones where timeframes conflicted. Ask, did I wait for resolution? Or did I jump the gun? That simple audit can transform your decision-making. Because once you stop fearing conflicting signals and start respecting them, your trading becomes calmer, cleaner, and more consistent. Now we bring everything together. All the structure, psychology, tools, and alignment across timeframes. It's time to translate that into a full trade plan. Brian Shannon doesn't just want you to understand concepts. He wants you to apply them. Because mastery in trading doesn't come from knowing. It comes from executing with consistency, clarity, and control. And that starts with a trade plan grounded in multi-timeframe logic. Step 1. Identify trend. Always begin at the top, weekly chart. Where is price in relation to its key moving averages? Is there a clear uptrend, downtrend, or range? This sets your directional bias. If the weekly is trending down, no long setups deserve your focus. Shannon stresses that trend filters are your first defense against low-probability trades. Step 2. Define structure. Move to the daily chart. Identify recent swing highs and lows, areas of support and resistance, and anchored VWAP zones from key events. Earnings, breakouts, failed moves. Shannon teaches that these levels tell you where the real battles are. You're building a map, not just for potential entry, but for where conviction will be tested. Step 3. Prepare for execution. Now you drop to the 15-minute or 30-minute chart. This is where the rubber meets the road. Shannon advises looking for consolidations, pullbacks, intraday breakouts. But only if they form within the daily structure and the weekly trend. That's alignment. No guessing, no chasing. Now comes the psychological glue, scenario planning. Shannon is clear. You don't just plan to win, you plan for every outcome. What if the breakout fails? Where is your stop? What does a failed setup look like, and how will you recognize it? What is your maximum risk? What's your trailing stop logic if it goes your way? You build this in advance, not in real time, because emotions don't belong in execution. Next is risk management. Shannon insists your trade size must match your confidence and the time frame. Swing trades get wider stops and smaller size. Intraday trades get tighter stops and quicker exits. He warns against mixing these up because when you risk swing size dollars on an intraday setup, your stress skyrockets, and that sabotages execution. The final piece is review. Every trade you take becomes a teacher. Shannon recommends keeping a simple log. What was the weekly trend? What daily level triggered the trade? What intraday signal did you use? Did it align? Did you follow the plan? This review builds your mental model. It trains you to trust structure, not emotion, and it sharpens your edge over time. Here's what a complete trade plan looks like in Shannon's world. Weekly trend up, daily pullback to rising 20 MA and anchored VWAP. Intraday forms a tight consolidation above support. Breakout triggers with volume. Stop below the intraday low. First target at prior daily high. Position size to 1% risk. Trailing stop based on intraday VWAP. Review scheduled after close. You notice what's missing? Hope, impulse, FOMO. There's no space for gambling in this framework. You've removed randomness and replaced it with process. That's what makes Shannon's system so powerful. It's not about finding perfect trades. It's about building a repeatable process that filters noise, clarifies structure, and aligns your mind with your method. This echoes the disciplines of the best in the game, from Brett Steenbarger to Mike Bellafiore to Mark Douglas. Process over prediction, structure over excitement. Shannon's contribution is giving you a clear, visual, actionable framework to live that philosophy in real trades. So here's your final challenge. Build your own trade plan template using Shannon's structure. Print it, use it, refine it. Because the only edge that lasts is the one you can repeat day in, day out, without deviation. That's what separates amateurs from professionals. Because in the end, your goal is not to predict the market. It's to prepare for it with structure, discipline, and conviction. You've just walked through a masterclass on multi-timeframe trading from Brian Shannon's playbook. From trend alignment and anchored VWAP to emotional control and structural clarity, the pieces are all here. You now understand how to read the story behind price, how to avoid traps by aligning timeframes, and how to build a disciplined, repeatable process. You've seen that trading success isn't about guessing the future. It's about preparing for it with structure and conviction. So what do you do now? Reread Part 3 and Part 6, where Shannon dissects anchored VWAP and moving averages. Those are your foundation. Then build your own trade plan template like the one in Part 10. And journal. Journal every trade. Track how often alignment saved you and how often conflict exposed you. If you're ready to elevate your trading game, this is where it begins. Not with more indicators, not with faster signals, but with a mindset shift, with process, with clarity. And if you found value in this breakdown, comment below and subscribe for more deep dives into trading mastery. Because in the end, your edge isn't a secret formula. It's your ability to stay consistent, process-driven, and calm in the chaos of the market.